What's going on, everybody? So today we're gonna be going over what not to do. Okay, so we're gonna be going over what not to do with your trading. All right. So today's a perfect example of what not to do. All right. Now, what do I mean by what not to do? I'm talking about you taking stupid trades, taking stupid decisions, and not learning from you getting humbled. All right. So let me show you what I mean. Okay. So we're on the daily time frame, whatever, you know, daily time frame, right? Um, you guys do your daily bias thing, and you come out to the conclusion that you are bullish, right? 4 hour time frame, we got a lot of sell side here, but we aren't dipping into it, and we seem really bullish. We just swept buy side here, so if we want to be bearish, we want to see displacement to the downside. We come to the 1 hour time frame, we get this 1 hour fair value gap, this 1 hour BISI getting mitigated here, so we can mark this out as our higher time frame PD ray getting filled in here. Then we come to the 15-minute time frame, right? We start to see that price is respecting this 1 hour fair value gap, so we think price is going to run higher, right? We let price play out, price keeps running higher. We don't get any retracement besides this retracement into this fair value gap. But remember, we want to buy in discount, right? And discount is all the way down here, right? Right below the 0.5 level, or at the 0.5 level. So what discount would be for us would basically be this breaker, this breaker here. And what's inside this breaker is this fair value gap right here. So these two PD rays can be used at equilibrium to rebalance price, right? Now, we want price to come all the way down to there. But do we get that? No. Price just keeps on running, right? Price keeps on running. And if we come to the 1 minute time frame, right, and we measure out our standard deviation tool, and we see how far price could actually go, we can see that price actually can possibly run all the way to up here. And do we see that happening right now? Yes, price just ran through there now, okay? So we're thinking we're super bullish, right? We're waiting for price to come all the way down to discount. Price drops down, taps into this order block here, then price displaces higher. Once we get this displacement over this high, we're super bullish. We're still super bullish. We're having all these premium gaps using as fractals that we can enter off of. But because they're fractals, right, that's going to be higher risk for us. Because fractals should be used as scales. We don't even have our main entry yet. If we got our main entry, it would be somewhere all the way down here, but we don't get that yet. So what are we waiting for? We're waiting for our retracement back down to the downside, right? So when we're looking at this, what is a PD ray that we can use for us to get another long in, right? Got this breaker. Got a 5-minute fair value gap here. We got an order block here. So let's mark out all of these for now, okay? So we got this order block. We got this fair value gap. We're thinking we're still super bullish, right? Still super bullish. We let this play out, right? Price still keeps coming higher. Didn't even tap into this fair value gap yet. Now price is starting to come back down. We disrespect this fair value gap, but hey, we're super bullish, so we should be continuing higher, right? Boom. Displace through here. If we entered on this gap, we would have got stopped here. Boom, we're in on this order block here, right? Boom, right here. Stop loss. Or not right there, but we're in for a long here, right? Stop loss down here, right? Below the order block here. What happens? Oh, we're starting to respect it. We have a SIBI here. Watch that SIBI there. Boom, we get stopped out. Why did we get stopped out, guys? Why did we get stopped out? We're super bullish, but why are we getting stopped out? Boom, we have a breaker retracement. Where's this breaker in? Is this breaker in premium or discount? It's in discount. Maybe we can enter on this breaker. Stop loss below the breaker, right? But maybe this will work out for us, right? Boom, we get stopped out again. Oh, we're in OTE right now, right? We're in OTE. Why are we getting stopped out, guys? We're still in OTE. Maybe we can go for a long again. Maybe stop loss below this low here. Whatever. Boom. just get stopped out. Just get fucked up. Now you might be asking yourself, why are we getting fucked around? We're super bullish here, but why are we getting stopped out here? We shouldn't be getting stopped out if we're really bullish. We took out sell side here, and we also took out Asian lows, and this created our low of the day. Why are we bullish? Or why are we bearish? We're super bullish right now. We should be going higher. If we come to the 5-minute time frame, right? There's no indefinite intermediate low that we create. There's no intermediate low that we definitely create other than this low right here. This low right here is the last recent low that was created on the 5-minute time frame. Okay, so this low would act as our intermediate term low. Okay, so for us to displace over this low, this would be our market structure shift on the 5-minute. But how can we tell if price is reversing or changing, right? How are we supposed to understand that? Number one, we can find ourselves getting some sort or some type of SMT going on, right? So when we have an SMT going on, that means we're going to have one market doing this at the highs, one market doing this at the highs, one market doing this at the highs. Okay? So this between YM, ES, and NQ. That's the first thing we can look for. Second thing we want to look for is the lower time frames for some sort of shift in market structure. Also, if we can find on the lower time frames some type of sweep of liquidity, that will also give us some type of insight of the market reversing on us, right? So if we come to the 1-minute time frame, right? We come to the 1-minute time frame. What do we see here? Do we take any liquidity here? No, we do not take any liquidity at all, right? So, because we didn't take any liquidity over here, that gives us an insight of that we could possibly have a bearish SMT because we created a lower high here. So, if we come over here and let's create a new tab here, whatever, and let's go to ES, right? We go to S&P 500. We go to the 1-minute time frame, and let's come all the way up here. And you know what? Fuck it. Let's double it up here. Okay, let's double it up here. So let's figure out if we create an SMT here. So this is our high, basically right here. This is our other high, or right here, basically. So on NQ, we're creating lower highs here. On ES, we're creating higher highs. So because we're creating higher highs on ES, and we're creating lower highs on NQ, we have an SMT on a NASDAQ creating lower highs, while ES is actually taking out liquidity here. So this will translate over to NASDAQ not needing to sweep liquidity because it already did it on ES. And if we take a look at YM as well, we can do the same thing for YM, right? Take a look at YM here. We're creating lower highs as well, or higher highs actually. Sorry, we're also creating higher highs here as well. So when we take a look at this SMT here, we're creating higher highs as well. So NASDAQ is the one that has the weakness in strength right now because we didn't have sweeping liquidity here. We created a lower high. So because of that, NASDAQ is going to be most likely the most bearish market out of the three, right? And as you can see that we dumped. But how can we anticipate this? First, we've seen that we have our SMT for our reversal here, right? SMT, bearish SMT. What is a bearish SMT? That means we're going bullish. We create an SMT at the highs. One creates a lower high. One creates a higher high. Seeing the one with the lower high is anticipated to be the one that's going to be more bearish, having that cracking correlation between the three interlinked markets, right? ES, NQ, and YM are all interlinked. So remember, when you have interlinked markets like that, when you have an SMT divergence at the highs, that's known as a bearish SMT. The one that didn't take liquidity, one that didn't take buy side, is going to be the one that's going to be the weaker one of the pairs. And with the weaker one, that's going to be the one that's going to be having more of a bearish sentiment in the market, okay? Next thing we want to look for. Since that on the 5 minute, right, this would have been our south side liquidity or our last low that we had created. We want to see it displace over this low, but that's a long way. If we're all the way up here, that's over 300 ticks that we got to move down. So what do? Come on to the lower time frames. Wait for that first displacement over that intermediate term low. Where's that? Right here. How is this an intermediate term low? Short term low. Short term low here. Two short term lows on the left and the right. Right? Having our displacement over here. Now, obviously on the 1 minute, this would be our indefinite shift in market structure right here. Okay? This would be our indefinite shift in market structure. But because we didn't take liquidity, we can use this as displacement, right, over this low for an entry. What would our low risk entry be? Since we didn't take liquidity, right, if we're looking at a breaker block, right, it'll be looking something like this. And this right here would be our breaker, right? We would enter here. Market comes up into this breaker block, displaces downwards, right? Would this candle be our breaker block? No. This would be a mitigation block. Why would this be a mitigation block? Because we didn't take buy side. We didn't liquidate buy side. So because we didn't liquidate buy side liquidity here, and we only liquidated it on ES, remember? We took liquidity on ES. We didn't take liquidity on NASDAQ, remember? So we swept buy side liquidity here. We didn't sweep any buy side here. So because of that, this would be a mitigation block, not a breaker block. Say we came up, though, made a low here, displace, and then displace back down. This would then be a breaker block. But because we didn't, this would be considered mitigation block. And this is one of the main types of smart money reversals that you will see inside the markets. A mitigation block reversal, having a failure swing. Okay? So having failure swings, this is a type of turtle soup that we can use to our advantage. Having an SMT with a mitigation block. That's a perfect example of what we could use for our low risk entry. So say we have our first entry here, right? First entry right here, right? This would be our first sell entry right here. Displaced down lower. Now we have our indefinite shift in market structure. What do we also have now? We have a 5 minute inverse fair value gap. Why is it an inverse fair value gap? Because we displace having a body close over this BISI. So this BISI turned into a SIBI, which is now known as an inverse fair value gap, right? Come back to the 1 minute time frame. This is our inverse fair value gap. Where would we enter on? We could enter on this SIBI here. We could enter on the tip of the SIBI. But because this is inverse on a higher time frame, this is a major POI for us, point of interest for us. So where would we enter here if we didn't get this main entry here? We would enter right here on this inverse fair value gap. And this would be our either first stage distribution, or this would be our low risk entry if we didn't catch this one, right? Now, I didn't teach you guys about market maker models, but I'm giving you guys a little insight right now, okay? Market maker models is basically combining multiple models together to form basically this one big model, the bigger picture, right? I'm giving you guys little insights into this, but I'm also giving you guys a tape reading walkthrough of what to not do, because I just gave you guys an insight of what it looks like to trade with an expectation of being bullish when you're actually changing biases now, adapting to being bearish, which at the same time you're going to have to use that when you trade market maker models, which is one of the most advanced models to trade, right? But it's also one of the most profitable ones. So understanding how to do these little things will add up in the end when you trade these market maker models, okay? So if you miss this entry right here with this mitigation block, the next entry would be on this inverse fair value gap. And if you remember the 2022 model, what is the 3 steps for the 2022 model? Liquidity sweep, market structure shift, fair value gap. Where do you get your liquidity sweep? Not up here. You get it on ES. You swept on ES, right? but you didn't sweep on NQ. So where is your liquidity sweep? On ES, but that translate over to NQ, causing an SMT divergence. Where's your market structure shift? Right here. Intermediate term low right here. Short term low, short term low. Both short term lows on the left and the right. This is our intermediate term low. This is our market structure shift right here. And remember, what is a market structure shift? Market structure shift is a change in market sentiment, or it's a change from bullish to bearish, right? So you're changing directions basically. So it's a change in state of delivery. You're changing from a buy program to a sell program, or you're changing from a buy sentiment to a sell sentiment. You're changing from bullish to bearish, or bearish to bullish. Either way, you're just changing directions. That's basically what a market structure shift is. It's just a definite form of structure in the market that gives us that insight of that this is shifting sentiment right now, right? So if we miss this mitigation block entry, what entry do we get now? Where's our fair value gap? Boom, right here. SIBI. Or if we're on the higher time frames, 5 minutes inverse fair value gap now, right? So we can either use this inverse or we can use this SIBI right here, right? Either one. So we're going to use this inverse. This is our 2022 model. So 2022 model right here. We can have our low risk entry here, or our main entry here, or we can have it right here. Either one. Both are good ones. I want you guys to pay attention to these two runs though. Pay attention to this fill on this mitigation block right here and this run right here. Okay? And then I want you to pay attention to this fill and this run right here. Take a moment to see these two runs. You got it? In your head, you should be looking at this first one being like, oh, this thing shot down pretty good in a short amount of time. And if you look at this one, it really danced around, for a good, what is this? About 40 minutes. This one just delivered in about, 8 minutes right there. This is an example of low resistance versus high resistance liquidity runs. What is low resistance? When price runs like this, it just shoots down like a bullet. That is low resistance liquidity. That's because all this sell side here didn't get swept. Right? So having non-swept sell side gives you a good run on price because you don't need any pullbacks at all. When you have high resistance liquidity runs, you're pulling back like a lot. You're having pullbacks. See how many pullbacks we have. We fill. This is our entry. Boom. Enter the trade. First pullback. Second pullback. Third pullback. Fourth pullback. Fifth pullback. You just keep pulling back until we get to this big run right here. So, what condition do we want to trade in? Do we want to trade in high resistance liquidity here? Or do we want to trade in low resistance liquidity? Me personally, I want to trade in low resistance liquidity pretty much all the time. All the time. This is my preference. I want to trade in low resistance liquidity. That's my preference. I don't know about you guys, but I want to trade in low resistance liquidity. So, I want you guys to be focusing on getting these runs right here. Catching what? What is this? 260 ticks in 8 minutes. But again, I talked to you guys about getting 60 tick minimum. You guys can enter right here. 60 ticks, what is that? Right about there. You can be done trading for the day. You're done. You put one mini contract on right there. 60 ticks. That's $300 right there. Done for the day. Done for the day. Are you making $300 at your fucking 9 to 5 right now? In one day. If you are, how long are you spending on that job? 4 hours? 8 hours? How much are you spending? You know how much money, how much time you're spending on this trade alone? Literally less than a minute. Or at least 1 minute. You would have made $300 in 1 minute. The possibilities are endless with this shit. You just need to understand what you're learning right now. So, the conditions that you want to be trading in is going to be low resistance liquidity. So you see how it just pushes like a bullet compared to this high resistance liquidity. It's just dancing in here. It's just fucking doing its own thing. It's swimming in liquidity right now, doing whatever it wants to do. We don't want this. We can, but we have to withstand the anxiety of holding this trade throughout all these pullbacks. And if you're gonna sit here and be like, man, I'm fucking different, I can handle the anxiety. No, you can't. No, you can't. When you're starting out, the anxiety will get to you, and I can promise you, literally, what do you guys want? You want a Lamborghini? I don't got one, but I can sure as hell promise you one. I can promise you one when you get there and fucking, whatever. Like, whenever you make it in trading, which you guys will, I can promise you, I'll get you guys that Lamborghini. Okay? I'll get you guys that Lamborghini because I know you guys are going to get anxiety when you have high resistance liquidity runs. Why? Because you're going to stare at the charts, seeing these pullbacks and being like, oh, fuck, I need to pull this trade. I'm going to lose all this fucking money. When in reality, it's going to go in your intended direction. It's just going to dance for a good minute or so, And you need to withstand all of that, alright? And forget what I said about the Lamborghini. You ain't getting shit from me. Okay? But what I am going to give you is this insight of what condition market to trade in. You want these low resistance liquidity runs. You want these bullet trades, right? You want these like quick trades right here. Why? Because you have a bigger velocity than you do here. And you do this in literally less than quarter of the time than you do here. Okay? So I want you guys to be focusing on these low resistance liquidity runs. So after, let's say you enter twice, right? You're in on both trades. What do you do now? You take out your standard deviation tool. You measure out the manipulation move. Pull out your standard deviations. And you measure out to negative 4.5. Now what does negative 4.5 look like? Could it be that our draw on liquidity, our 1 hour time frame fair value gap, right? Could it be that our 1 hour time frame fair value gap is literally perfectly in line with negative 4.5 standard deviations away at not the open, not the close of the gap, at consequent encroachment, at midpoint of the gap? Could it be that it's perfectly in line? Look at my crosshairs right now. Is negative 4.5 literally perfectly in line with consequent encroachment? Oh my gosh. Oh my gosh. That's literally algorithmic. It's literally algorithmic. And you're going to tell me that ICT concepts don't work and that, ICT is a scam and none of his concepts work. Tell me how this 1 hour gap, a totally different time frame, right? A totally different fucking time frame, right? Tell me how this 1 hour gap right here is perfectly in fucking line with negative 4.5 standard deviations away. Tell me. Literally explain to me. And if you're going to say to me, oh, it's just a coincidence. Really? So it was a coincidence that it happened today. I didn't cherry pick this. This is literally today. Look at the time right now. It's literally, look at the bottom right here. Friday the 23rd of February, 2024. This happened during New York session during the opening range, which is from 9:30 to 10 o'clock a.m. New York Eastern Standard Time. Negative 4.5 standard deviations is literally perfectly in line with this 1 hour fair value gap at consequent encroachment. That's our draw on liquidity. That's the target. Why? Because we didn't fill this enough. So it's still left unfilled. We didn't rebalance price. We tagged it, rejected it higher. Now we're coming back into it to rebalance it. So we can use standard deviations to anticipate where the market wants to go. We can set our TPs here. We can set our TP here for our negative 2 or negative 2.5. This is most likely going to be where you're going to want to set your TPs between these two standard deviation points. And look, what's in the middle? What's in the middle? Is that a sell side liquidity point? No ways. And did this run right here just take it out? No ways. This could have been a TP for you. Boom, re-entry. Got to deal with this high resistance liquidity bullshit. But where do you go all the way down into? Negative 4.5. That's your TP. You hold this trade from here all the way to negative 4.5. Almost 400 ticks. 400 ticks. That's literally like, that's like 8x, almost 8x what you would have made with 60 ticks. Almost. Not quite. Almost though. You want to aim for 60 ticks. Don't be looking for these 400 tick moves. Don't be looking for these 100 tick moves. If you get them, great. But look for these 60 tick moves, because that's what's going to gain you consistency. Getting 60 ticks every single day. 60 ticks, 60 ticks, 60 ticks. Right? You don't need these 400 tick moves. You don't need these 200, 100 tick moves. You get 60 ticks. That's all you need. Okay? Get the minimum. Get the minimum. Okay? So, what I don't want you guys to be doing is being stuck on these lower time frames, looking at all these fucking candles. I also don't want you, what I don't want you doing also is staying on these higher time frames, waiting for displacement on the higher time frame. I want you to be flicking back through these 3 time frames over and over again. You know, seeing, oh, okay, what is the draw on liquidity on the higher time frame? Okay, we displaced over this high, but boom. You know, I want to see what we're coming back down into. We could retrace, but there's nothing to retrace back into unless we come into the 1 hour time frame. Boom, 1 hour. What happens here? On the 1 hour, this 1 hour candle, we get a wick close over this high. What does that mean? Oh, we might be bearish now. Come to the 15 minute, we have displacement, but we don't have displacement on the 1 hour. We have failed displacement. So what do? Come to the 5 minute. Oh, we don't really have any structure. What do? Go to the 1 minute. Boom, now we got structure. Now we see a setup for me. Mitigation block setup. Boom, entry right here. Boom, 2022 model here. Boom, enter on this fair value gap. You need to flick through all of these time frames to be having a multitude of views of what the market is doing. You can't just be stuck on the 1 minute. Can't be stuck on the 5 minute. Can't be stuck on the 15 minute. And also, get the fuck off your phone. Do not be on your phone when you're fucking trading. Okay? If you're going to be on your phone, it's going to be entering a trade on MetaTrader. If you're going to be on your phone, that means you're already in a trade and you're just not trying to get anxiety. Okay? Get off your phone. Alright? Just focus up. Pay attention to a multitude of time frames. Make sure the lower time frames lining up with the higher time frames. If they're not lining up, check a different time frame. And if all of those time frames are lining up with your lower time frames, you're doing something wrong. So be aware of your surroundings of time frames. Flick through them. Be adapting to it. You know, don't be quick to be closed-minded to one time frame. Have a multitude of time frames. So what I came on this video to talk to you guys about is what don't do. So what am I saying to not do? Don't get stuck on one time frame and flick through time frames. And also, don't be so convicted to be bullish the whole time or bearish the whole time. Be open-minded so that you're able to adapt. If you're not able to adapt, it's going to be really hard for you guys to be able to switch up your biases when the draw on liquidity changes for the market, for the algorithm, right? When markets hit its draw on liquidity and it's targeting the next draw on liquidity, you guys need to adapt to where that will be. Okay? So be able to do that. Alright? Being able to adapt is really important. So make sure that you guys are able to adapt in that sense. But other than that, I hope you guys have a good rest of your day. And I'll see you guys in the next video. Peace.